Welcome to the Fintech One-on-One podcast. This is Peter Renton, chairman and co-founder of Fintech Nexus. I've been doing these shows since 2013, which makes this the longest running one-on-one interview show in all of Fintech. Thank you for joining me on this journey. If you like this podcast, you should check out our sister shows, Pitch It, the Fintech Startups podcast with Todd Anderson, and Fintech Coffee Break with Isabel Castro. Or you can listen to everything we produce by subscribing to the Fintech Nexus podcast channel. Welcome to the podcast, Clara.
Thanks for having me. Looking forward to the conversation.
Likewise. So let's kick it off by giving the listeners a little bit of background about yourself. I know you've been at Revolution for some time, but can you just give me a little bit of the background on your career?
Yeah, absolutely. So I started my career in investment banking. I joined the leverage finance and financial sponsors group at UBS right after I graduated from Stanford. And that group quickly rebranded to leverage finance and restructuring. It was, right in the 08, 09 time period. So a pretty turbulent time to be doing that sort of work. I left there with one of the managing partners from our group to start our own restructuring firm. And the thesis there was there's going to be a lot of bankruptcies coming out of that acute period of time. And, there were a number of firms servicing mid-market and upstream in terms of the restructuring side of the business, but nobody really doing the lower end of the market because it wasn't really a profitable part of business. And we thought we could apply a little bit of technology and be able to service that side of the business better and really own that piece of the market. Ultimately, Obama was very successful in terms of righting the ship in 09, 2010. And that wave of bankruptcies that we had predicted were really all refinanced out. So that just fundamentally didn't work in terms of a thesis. And I went and started working for one of my old bosses from UBS at a fund formation and secondaries trading platform, really focused on venture and growth managers. And in that capacity, I got to know Steve Case and Ted Leontis and David Golden and Tig Savage, who are my partners now at Revolution. Helped them raise our first institutional fund back in 2010, and then joined full-time shortly thereafter, helped launch our San Francisco office, and have been focused on the venture side of our firm since then. So really Series A, Series B opportunities, anywhere from call it 3 to 15 million as an initial check-in, and partnering closely with founders to help scale their businesses.
Right. So Steve Case, obviously famous through AOL, and did this sort of start out as a family office type thing, or or to tell us a little bit about the origins?
Yeah, exactly. So when Steve left AOL, he really began Revolution as a family office, largely his capital, but also some of the other principals. We invested about $500 million across a bunch of early stage companies that turned into follow-on activity that turned into the natural constraints of investing under a family office. And when the recycling portion of the strategy broke down a little bit in 08, 09, it became clear that in order to continue to support the portfolio companies and still be able to make investments in new opportunities, we should raise a little bit of outside capital. We've done that. We've got close to $3 billion under management at this point, and it's largely outside investors. So, your typical LPs, foundations, endowments, pension funds, et cetera.
Mm-hmm. Okay. So then, what was it that attracted you? Was it a specific opportunity about Revolution, or was it just venture capital in general? What made you kind of take this career step?
Well, I think as somebody who lives in San Francisco and went to Stanford, venture capital is interesting in that regard. I think I've always liked the mix of math. My dad's a math professor, and sort of the human and real world applicability that sits at the nexus of early stage venture. So that personally just fits well with me. And I think Revolution's perspective was particularly interesting to me because they have had a long history of focusing on, in some sense, sleepier, more legacy pieces of the broader venture ecosystem. Financial services certainly being one that we were very early investors in, and have continued to scale into that category. It's now broadly called disruption, but at the time, not very many people were focused on it.
Mm-hmm.
There's more of a focus on kind of tech for tech's sake in the early 2000s when they got going. But personally, for me, as it relates to revolution, I grew up in Pittsburgh, Pennsylvania. That city has transformed dramatically from when I first grew up there. I mentioned before, my dad's a professor at Carnegie Mellon, and I've seen through that lens a city that's really transformed with education and talent, and a focus on technology. And I fundamentally believe that can happen all over the U.S. And that is a big part of what we focus on at Revolution,
Right.
really finding unique talent in different places. Usually that collides with where there's legacy industry, and so real knowledge of how those industries operate and where opportunity sits in them, and then putting capital behind it to help scale leading businesses in those categories.
Right. So it's interesting. You went to Stanford. You live in the Bay Area. You're still in the Bay Area today, and but you're not really focused on Bay Area companies. That's certainly how it's, and I maybe explain sort of what's the thinking there. What is? I mean, you just touched on it, but there's such an ecosystem inside the Bay Area, and
Yeah, absolutely.
there's so many tech companies there. There's a reason that other VCs have invested
Yeah.
primarily in that area. What's the sort of the contrarian view from like a typical Silicon Valley VC?
Yeah, so it's not an exclusionary um, mandate, right? We certainly invest in Bay Area companies. We invest in New York pretty heavily, LA, Boston, other places where there is a lot of venture capital. But I would say our mix as it relates to those places where there is more venture capital versus otherwise is probably 50-50, which for a typical venture fund is pretty focused outside of those quote unquote hotbeds. Um, I think there's a dose of reality in the fact that this is a very well-worn path out here, and there are a lot of players who have great brand names who will win the deal, and so if we're competing against them, often it's on price, and that doesn't feel great
Right.
to win just on price alone. And I think from our perspective, having an office out here is really powerful on two sides. One, we have better connectivity into talent and thesis development, as a lot of that is happening here, as you mentioned. And two, we have connectivity with the later stage investors. So after we come in at the Series A, Series B level, our portfolio companies are generally not profitable. They will be needing additional financing. So being able to serve as a connection between places that are a little bit more off the beaten path
Right.
to investors out here is really helpful.
So has that changed much though? Because obviously the last couple of years we've seen lots of companies become purely distributed. Some have just let go of their lease and don't have an office anymore. Does that sort of change your thinking as far as you might have someone who might personally live in the Bay Area, but the other co-founders live elsewhere, and the rest of the team is all over the place. So how is that sort of the geographical kind of shift that we've had over the last 3 years, shall we say? Has that changed sort of the venture capital landscape in any way?
Yeah, I think from a geo perspective, it's been a net positive. So again, our mandate is not exclusionary. We are not solely focused on places that have to be headquartered outside of the Bay Area or otherwise. I think it's been really beneficial to a lot of our portfolio companies because of the fluidity in talent, and the ability to get higher caliber folks on their team, distributed or not. So that's been really powerful. And I think there's been a more openness in investors' mind to it doesn't just have to be in San Francisco. Um, Portfolio companies can really be anywhere, and you can build great businesses in that way. For us, our North Star continues to be what the risk-adjusted returns will look like. That has a lot to do with the valuation that you go in at and the amount of cash that a company will consume to get to the end goal. So if we now believe that there are better risk-adjusted opportunities here that are somewhat distributed in nature, we'll go there.
Right. That makes sense. So then, with the sort of crazy kind of world, particularly in the fintech space of capital or valuations, I really should say, over the run up in 2021 into early 2022. Did you pull back a little bit from the fintech space because of that, or how did you navigate it?
We did. I mean, we have a little bit of a different approach as it relates to our pacing. We take a really concentrated approach. So we'll invest in call it 3 to 5 deals a year, where we're taking board seats, we're typically leading, and we're working pretty closely with those portfolio companies. And that's an average. So there are years where we won't put any capital to work. I think last year is a great example of that. There was a big slowdown and correction at the later stage, but Series A, Series B remained pretty frothy. So we pulled back dramatically and didn't actually invest in a single new deal last year. We really focused on supporting our portfolio companies. And I think that was largely because at the level that we invest at the Series A stage, most companies were still pretty wed to their more recent valuations and could get insider support to support those. And we didn't think it made sense to take 2021 pricing risk for 2022 market risk.
Right. No, that makes a lot of sense. So then, what are the typical check sizes you're doing? You said Series A, Series B. You typically lead. So what's the range of check sizes and the average?
Yeah, so range is really anywhere from 3 to 15 million as an initial check-in. We'll typically reserve about 2 to 3x per portfolio company. If it's a $15 million entry check, obviously those reserves are commensurately lower. If it's a $3 million entry point, that usually means we're co-leading something and it's on the earlier side of the Series A to Series B range. And then scale up behind that initial entry check.
Okay. So you didn't do investments last year. I want to talk about maybe you could touch on an investment that I know you made in 2021. Really interesting company. My colleague Todd Anderson had the founder on his podcast just a few months back, and that's Sila. Sila, which is, I think, a super interesting company, and I think you led the Series A. So tell us a little bit about what you saw there and how you feel like your thesis has played out over the last, I think it was like 18 months ago, right, that you invested.
Yeah. So we have long believed in embedded finance. We're not unique in that belief. And Scylla was a great entry point for us as it relates to that. I think there was a lot of momentum at the time in terms of BaaS solutions that were really rip and replace. And we believed that there was a real opportunity to, in some sense, have a point solution that made it easier to get regulatory compliant payments up and running on short order. And build a platform around that. So the founder there, Shamir, was one of the original founders of Simple, which was a very early neobank acquired by BBVA. He found himself at BBVA in charge of their APIs and quickly realized he didn't have much of a job. Right. Got frustrated with the slowness and lack of innovation there, and left there to start Scylla. We were really interested in the fact that they were able to do KYC, KYB effectively in a box and get customers live on ACH rails in record time, right? So if all goes well, you can get a customer up and running from MSA to go live in, as little as 2 weeks, whereas traditional banking, it's 12 to 18 months on a good day. And they've really built momentum behind that. I think because they're not a broader platform or a quote unquote BaaS solution, they have targeted mid-market and enterprise from the very beginning. So they both collect SaaS fees and transaction volume and haven't seen the same sort of churn that a lot of those BaaS solutions have, because they were focused on earlier stage venture opportunities and SMB businesses.
Right. That makes sense. Yeah, I'm a big fan of what those guys are doing. Another one that's in your portfolio, Paro. Tell us a little bit about that company.
Yeah, sure. So Paro's a labor marketplace focused on finance and accounting professionals. It's really premised on the fact that every company needs finance and accounting help. It can often be really, really expensive, particularly if you're going to one of the big four. And it's recurring in nature. So while you can sometimes think of it as more services revenue, really a book of their business, greater than 50%, is just on a recurring schedule that scales and has unique points of acquisition throughout the year, whether that's audit, year-end tax, or just monthly bookkeeping. We really like this category because from a supply perspective, labor supply perspective, that is, you've got a relatively risk-averse class of labor that doesn't want to disintermediate. They just want to have consistent work and tooling to support efficiency. Paro provides that and has built a really unique platform that enables better, faster work products. And then from a demand perspective, as I mentioned, it's really a recurring tool and business. You need to close your books on a monthly basis. You need help developing a financial model. And particularly in times like these, you need help potentially doing restructuring work. And every year you got to pay your taxes. And every year, for the most part, you got to do an audit.
Right. There is job security there for everybody who has that kind of background. So then when you look across at the broader fintech landscape, are there certain areas that you're interested in specifically, or do you kind of take it on a case-by-case basis with the deals that come into you?
We go deep on specific segments when we think it's worthwhile. I think we've got some broad strokes themes that we continue to pursue. When we first got started at Revolution, it was really focused on digitization. So one of our first investments was in a company called Revolution Money, which was, really migrating credit card swipe fees via the internet, cutting those down. It was ultimately acquired by Amex. That was a great purview into that first bucket of companies. The first check I wrote before I was even at Revolution was into a company called Blend, which was really moving the mortgage process online. Yeah. They've since gone public. It's been a really, really fun company to watch grow and scale. And so those are some of the companies that we think to as it relates to digitization and the earlier stages of fintech. As I mentioned, embedded finance is an important one. We've tended to focus more on the B2B side, but we also believe that most consumer products will end up, consumer brands and products will end up having some level of financial services embedded in them over time. And we continue to look at opportunities related to that. Insurance has been a category that's been pretty negatively impacted over the past 12 months as it relates to the public markets when you look at Lemonade and Hippo and others. But it's a category that we still really believe in. We're investors in a company called Wagmo, which is in the pet wellness and insurance category. They have differentiated themselves in terms of a really unique claims process that's great for the consumer, but importantly, have a big B2B business through the employer channels, which we think is a real moat go forward for them. And then to your top question, yeah, we do a lot of work around kind of nichier, underserved markets where we see real opportunity. So a great example of that is a company we invested in a number of years ago now called SRS Acquium, which is in the shareholder rep business. Basically, they own most of the market of post-closing VC and PE M&A stuff broadly defined. So you close the deal, there's an escrow. Nobody wants to be the shareholder rep. These guys have built a really nice services business on the front end that's profitable, that serves as a sales engine into the business that we really invested in, which is an escrow management business, go forward. So you can think of them as having a profitable sales channel that drives into a massive escrow business that obviously with interest rates adjusting has proven to be wildly profitable. And then we've worked on expanding a slew of services around that, whether that be rep and warranty, insurance, or otherwise.
Right. So I want to switch gears a little bit, and I want to talk about women-run companies and venture capital flowing to them. It's still a tiny fraction of what male-run companies receive. And just as a woman in the VC space, wanted to get your perspective on on whether you or how you sort of view that. Is that something that you are actively trying to change, or does that come into play when you're looking to invest in a company?
Sure. So we're not impact investors, we're returns oriented. I note that first and foremost because we're not a female focused
Right.
venture fund, right? But that being said, of my portfolio companies where I'm on the board, over 80% of them have at least one female executive team member, and over half of them are female CEOs. And I that's not because I take a lens of, okay, I actually weight having a female founder and CEO team more so than I do having a male founder and CEO team. I think it's really because when females are investing, their network tends to be a little bit more female oriented, right? I get more, proportionately more female founders that are introduced to me than my male partners. So I think the crux of the problem is in part solved by shining a light on it and having examples of success. I think that has happened through the past cycle. And in part giving more dollars to deploy to female allocators because of the natural point of one, network, and two, biases. No matter how much you're trained in it, you tend to like things that feel more like you.
Right.
And so it is helpful to have more perspectives at the decision-making table for sure.
Right. I know that's fair points, and something that I think we're continuing to try and shine the light on. So then there's much been made in the fintech space, especially about the dry powder that is sitting on VCs' balance sheets, because, like as you said, you made no investments last year, and you're not alone in that. There were several other prominent VCs that publicly said the same thing. So I'm just curious. I mean, you're a little bit different. Maybe you don't have the same sort of LP base that a typical VC has, but is there any kind of pressure to start deploying your dry powder in the near term?
Yeah, I mean, again, last year was super frustrating, right? We looked at hundreds of thousands of opportunities, and at the Series A level, there wasn't an appetite for most founders to reset and appreciate that they had raised at values that didn't make sense. I think a little bit of that was a COVID overhang. So when COVID first got started and everybody was pressuring their companies to extend runway because there were predictions of doomsday, there was maybe a month and a half
Right. It was
cycle
short, I remember.
where there was a little bit of a dip in valuations, and then it was to the highest level ever. So I think last year folks were kind of waiting on the sidelines and extending where they could at the Series A level and avoiding raising if they could. So what we saw was Most of the portfolio companies that were raising outside external rounds kind of had their backs against the wall because they didn't have insider support.
Mm-hmm.
And I think this year that's going to start changing. And there's going to be a greater recognition that this is a longer cycle, that this is not a blip in the roadmap, and that you can't extend forever. And I think there's going to be some really interesting consolidation and opportunities that come about. Consolidation in the sense that there are a lot of portfolio companies across the ecosystem that raised at kind of crazy valuations versus their revenue and are in some sense trapped in their cap tables. And maybe it makes more sense for them to consolidate with another company that did so similarly, and they can start to, build a business that is more rationalized. And similarly on the valuation front, as these portfolio companies go out to market and kind of have to take the medicine now. Last year we saw that shift at the later stage for sure, where the massive mega rounds, which we typically define as over 100 million, were down about 80% year on year, and new unicorn creation was cut in half. But we didn't see that same sort of shift at the early stage. We actually saw valuations go up at the Series A level by about 27%.
Interesting.
We think this year is going to be that shift at the earlier stage as insider rounds dry up a little bit, because you mentioned the dry powder, but there's also concentration limits in people's funds. So you can't just continue to support the same valuations forever.
Right. So as you sort of look ahead to this year, we're recording this in late January, but I'm curious. I mean, I presume you don't expect to be out of market the whole of this year, right? What's your kind of, particularly when I'm obviously interested in fintech, but even more broadly, are you confident that you'll be in market multiple times this year?
Yeah. I mean, can't perfectly predict the future, and I certainly wouldn't have said in January last year that we would be out of the market the whole year. But I just seeing where we are right now from a top of funnel perspective, and in the deeper diligence conversations that we're having, where there is an openness to a more rationalized valuation and structure go forward with a lot of these companies, I think we can pretty confidently say we'll be deploying a fair amount of money into this market this year.
Okay, well, that's a great place to leave it, Clara. Thank you so much for coming on the show. Really appreciate you sharing your thoughts with us today.
Yeah, it was great to connect. Thanks for the time.
See ya.